Most investors fear the inversion. Then the curve starts to normalize, and they assume the danger is fading. Historically, that second step can be the more dangerous phase. The wording is not disappearing, it is changing form. So this is not about whether inversion matters. It does. This is about why re-steepening can matter more. Scream forms just fine. Start with the simplest version. A curve is inverted when short-term rates rise above long-term rates. In this case, the 2-year yield moves over the 10-year. That unusual shape matters because it usually tells you policy is tight enough or growth expectations are weak enough, that the normal term structure has been disturbed. But a market cycle does not end when the curve inverts. It ends when stress moves through funding, credit, earnings, and finally, asset prices. That is the real distinction: relief steepening versus distress steepening. A reassuring steepening is the easy case. Growth improves, inflation stays manageable, long yields rise because investors expect stronger activity, and the curve steepens on confidence, not panic. The dangerous version works differently. The short end falls as the market prices aggressive cuts. Those cuts are not about healing. They are about something cracking. The short end is tied to expected policy. When traders price emergency easing, the 2-year can drop fast, long before the public sees obvious damage. The long end does not have to follow. Inflation can stay sticky, Treasury supply can stay heavy, term premium can stay elevated. So the 10-year can hold up even as the short end drops. That combination makes the curve re-steepen. On the screen, it looks healthier. Underneath, it can just mean the market is pulling rescue forward. And rescue pricing is not cheerful. It usually means markets are discounting weaker growth, tighter funding, rising defaults, or a policy mistake big enough to force a reversal. In other words, the curve can stop looking abnormal because the bond market has become more convinced that stress is spreading through the system. That is the mechanism. Some steepenings reflect relief. Others price deterioration. First, the cleanest way to test that idea is to compress the history and look only at sequencing. Not every macro detail, not every recession indicator. Just the order in which the curve and risk assets moved. In the late 1980s, the curve inverted first, then it steepened back out as rate cut expectations grew. The equity peak and drawdown came after that transition had already begun. In the dot-com cycle, inversion came early. The real damage arrived after the curve began to normalize. The 2006 to 2007 sequence is even more instructive. The curve flattened, inverted, then steepened again as stress built beneath housing, funding, and structured credit. Those cases do not prove destiny. But they point to the same warning. A more normal curve can arrive beside real damage. That changes the watching framework. Instead of asking only whether the curve is inverted, you start asking what kind of steepening is taking place, what is driving it, and what usually comes next. Slightly accountantly, the historical pattern matters because it fits policy logic. Central banks do not rush toward cuts when the system is healthy. They move when growth, funding, or credit is worsening. Once that shift enters pricing, the short end reacts first. That is why the 2-year often tells you more about stress than a headline index still near its highs. At the same time, the long end can stay firm. Inflation may not be dead. Supply can stay large. Investors can still demand duration compensation. That keeps the curve from simply collapsing flat. So, a distress steepening is not just a chart shape. It is a transmission story. Policy expectations, funding strain, growth fear, and risk pricing moving through different maturities at different speeds. That is why normalization can mislead you if you read shape without cause. The shape says less than the driver underneath it. That brings us to the live question. The useful question today is not whether the curve still looks inverted enough to scare people. The useful question is what kind of normalization the market would be pricing from here. If the short end starts falling because investors are bringing forward aggressive cuts, while the long end stays firmer because inflation, supply, or term premium still matter, that is not a simple all clear. In that case, a cleaner-looking curve would not automatically mean lower risk. It could mean the bond market is moving first again, repricing the need for rescue before equities fully absorb the implications. That is why you do not watch the curve in isolation. You watch it with credit spreads, funding markets, earnings sensitivity, and the broader tone of liquidity. The signal is strongest when these things begin to rhyme. The point is not to predict the exact week of a drawdown. The point is to recognize the phase shift, from structural anomaly to policy repricing to transmission into risk assets. When that phase shift begins, the curve can look more normal at precisely the moment the system becomes more fragile. That is the setup worth monitoring. Keep the distinction clear. Inversion is the warning. Re-steepening can be the transmission phase, when that pressure starts reaching asset prices. A normal-looking curve is not always good news. Sometimes it is the market's way of saying the next chapter of the stress cycle has already started. That is why this is better used as a lens than a clock. When the bond market stops looking broken, ask what had to break first to make that happen.